A dividend is one of the simplest ways investors make money without lifting a finger. When a company earns a profit, it has two choices: keep the money to expand or share it with investors. That shared portion is what we call a dividend. Most of the time, dividends come in cash, deposited straight into your account. Imagine this: a company announces a 50-cent dividend. If you own 200 shares, you wake up to $100. You didn't sell anything, and your ownership remains intact. Mature companies with stable profits are the ones most likely to reward shareholders this way. That's why many investors chase dividend-paying stocks. They provide a steady stream of income, almost like a paycheck, but from your investments. But here's the catch: not everyone qualifies automatically. To receive the payment, you must own the stock before the ex-dividend date. Buy it too late and you miss out completely. Some investors don't even take the cash. They reinvest it through what's called a DRIP, automatically buying more shares. Over time, this reinvestment compounds, snowballing into potentially massive returns. Dividend yield is how we measure income compared to price. A stock priced at $40 that pays $1 in annual dividends has a 2.5% yield. This number helps investors compare opportunities, whether between stocks, bonds, or savings accounts. Of course, dividends aren't guaranteed. Companies can reduce or cancel them. And in times of rising interest rates, dividend stocks may lose appeal as investors chase higher yields elsewhere. Still, history shows dividends have been a reliable source of income through bull and bear markets alike. They're not just extra cash, they're proof that a company is strong enough to share its profits with you. So, take advantage and subscribe, share, and comment to get information and tips on finance. Thank you. See you in the next video.